In June 2020, India banned 300 Chinese apps. For many watching the news, this looked like a decisive economic victory. The public celebrated what appeared to be a successful defense of domestic markets against a major rival. But all that noise and celebration created a massive blind spot. The country was focused entirely on the border and digital bans, leaving the back door open. During that exact same month, another foreign power began acquiring massive stakes in Indian banking, logistics, and critical startups. They did this without triggering any headlines, without any public outcry, and without any government bans. The loudest international conflicts often provide the ideal cover. While everyone watched the confrontation with Beijing, Tokyo was quietly pulling off one of the largest financial acquisitions in modern Asian history. Relying heavily on rapid foreign capital carries massive risks. We only have to look at the 1997 Asian financial crisis to see the devastating consequences. When the Indonesian economy collapsed, millions lost their life savings, banks failed, and violent riots tore through the streets of Jakarta. That crisis was triggered by a simple mechanical flaw. Indonesia's boom was built on outside money. When investors saw instability, they pulled their money out. The local currency lost 80% of its value almost overnight, triggering a complete systemic failure. Today, Japan has committed an estimated 10 trillion yen, roughly $68 billion, to India. This money is pouring into physical infrastructure, from high-speed rail to metro stations, and into the core of the financial sector. We have to ask whether this massive influx of foreign cash is actually building India's long-term development, or if it is laying the groundwork for the exact same kind of invisible vulnerability that broke Indonesia. The silent superpower buying up these Indian assets is Japan, and their motivation has very little to do with charity. To understand why they are moving so aggressively now, we must go back to 1989. That was the year Japan's seemingly unstoppable financial bubble burst. The fallout from that crash created what economists call the lost decade. But it lasted much longer than 10 years. Land prices plummeted, companies stopped borrowing, and the entire economic engine ground to a halt, trapping the country in a 30-year cycle of stagnant wages and deflation. Compounding this financial freeze is a severe demographic decline. With an aging and rapidly shrinking population, Japan simply does not have enough young consumers left to drive domestic spending or take out new loans. When your own market offers zero growth, you have to look outward. Japan's billions flowing into India represent a desperate structural necessity. They have to export their capital to survive. In 2023, the Tokyo Stock Exchange forced an intervention. They told stagnant Japanese companies they needed to become profitable and return value to shareholders, or face severe penalties. This targeted a legacy system called cross-shareholding. Japanese banks and corporations held each other's stock, protecting executives but trapping trillions of yen as dead assets. New regulations forced their liquidation, flooding Japanese megabanks with billions in liquid cash. This created a unique problem. These banks now hold massive reserves of capital, but they operate in a domestic market with zero demand for new loans. They have to deploy that cash somewhere else. Historically, that money would have gone to China, but Chinese labor costs have risen sharply, eroding the profit margins that Japanese manufacturing relies on, especially when compared to the much cheaper workforce available in India. Beyond the economics, there is a severe military risk. Escalating naval threats and territorial friction, specifically around the Senkaku Islands, have made relying on Beijing incredibly dangerous for Tokyo. Facing high costs in their factories and military hostility in their waters, Japan found itself boxed into a corner. India emerged as the only viable geographical and demographic escape route, capable of absorbing this much capital. This brings us back to the Indonesian collapse. With all this foreign money flooding in, we need to ask if India is stepping into the exact same sovereign debt trap. The fatal flaw for Jakarta in 1997? They borrowed heavily in US dollars. When the local rupiah crashed, repaying those dollars became mathematically impossible. Unlike the dollar, Japanese loans to India are issued in yen. Because Japan's economy is deflating, the yen is weak. India generates revenue in a growing rupee, but pays debt in a weakening yen, drastically lowering the actual repayment pressure. Because of this specific currency structure, India protects its sovereign wealth. Rather than a predatory trap, this capital injection functions as a symbiotic exchange between two economies with entirely opposite problems. To secure this massive economic bet, you need diplomatic armor. The Quad Alliance, aligning the US, Australia, Japan, and India, acts as a calculated risk management structure, actively protecting that $68 billion commitment. This protected capital facilitates massive hardware transfers, supplying the precision manufacturing expertise and high-speed rail technology necessary to transform India into an industrial heavyweight. We are watching a structural inevitability play out. A demographically collapsing, capital surplus Japan is merging its financial survival with a capital-hungry, rapidly expanding India. India now serves as the critical survival mechanism for the Japanese economy. Together, these two nations are quietly merging their futures and rewriting the balance of power across the Indo-Pacific.